So welcome everybody. This is our very second Lunch and Learn with CREGG, Commercial Real Estate Going Green, our Lunch and Learn webinar series about saving money and energy in your buildings. And we are delighted and thrilled to have Joel Dobrin here with us today as our speaker, talking about cost segregation. Thank you, Joel.
Thank you, Stephanie. Sorry for that pause there. Yeah, thank you.
I would like to edify and introduce my co-host, Marika Erdely. She is the founder and CEO of Green Economy. And myself, I'm Stephanie Zapalak, a business development officer for Stewart Title Guarantee Company. Marika and I are excited to host this series together. Our second one today. This is going really well.
Hello, everyone. It's Marika, Green Economy. Thank you so much for joining us. We're really excited. Just a couple of housekeeping notes. All participants will be muted for the duration of the presentation. Please, any questions you may have, please submit them via the chat or during our Q&A. And just a note, this presentation will be recorded.
Wonderful. And so a couple of notes about our upcoming speakers in the months ahead. We're doing this once a month, which is fun, and we want you all to bring your lunch and your curiosity. This is a casual arena here, but just to let you know, on April 28th, we're going to be discussing Healthy Buildings Part 1 with Brett Usher from Walters Wholesale Electric. Late May, on May 26th, we're going to then do Healthy Buildings Part 2 with Andy Sagar of MCore Services Mesa Energy. June 30th, we're going to do Designing Green with Nicole Cannon of NCA Studios, Inc. And out in July 28th, we're going to go ahead and do a case study, Savings in Green Design in the Hospitality Industry with Suzanne Mellon. I'm very excited for that one. And of course, we'll have speakers lined up throughout the summer, but that's up and coming what we have going on, so you can spread the news, spread the word.
Great, yeah, I think those are all really relevant topics, so I think they'll be really interesting, so please tune in. We're also going to have these on our website, so you're welcome to listen to them afterwards. So what are we going to do today? Well, we're going to talk about what is cost segregation. It's a very important, we can see it as really a big benefit, and who can benefit. How does it work? We have our expert here today is Joel Dobrin.
Again.
And Joel and I met on a networking group, I don't know, maybe 4 years ago. We had a great lunch once we were talking, and also he's also a UCSB grad, which I am too. Go Gauchos, also an incredible athlete. And Joel knows all about cost seg. He's a great expert. We thought we'd bring him in and a bit of his humor as well, as you'll see, to help advise on what it is all about and why you would want to do it. So Joel, hey, thanks for coming.
Thank you. I'm thrilled to be here. I see Benny. I love seeing you live, Benny. I don't know if anybody else is going to join us on audio. I hope so. If not, okay. We're going to roll like you're here. So I'm thrilled to be here, and we can kind of jump right into this. Cost segregation. For those of you that may be aware of it or have heard about it, we generally find that by and large, it is a very underutilized. It still remains an underutilized and what I refer to sometimes as a hidden gem of the tax code. And it is a powerful savings tool that allows individuals and business owners to reduce their current income tax by accelerating depreciation. And we do this by reclassifying elements of individual buildings, both commercial and residential rental, as I'm assuming everybody can see the timeframes here on the screen. So how does this work? And most importantly, how is this going to benefit your clients that are looking to go green? So here's what we do. What the IRS allows us to do, first of all, is we separate the building from the land because the land is not depreciable. And then once we take a look at the building, we're able to move items into shorter life periods of 5 years for personal property and 15 years for land improvements, rather than spreading it out over a full 40 years. So the goal here is, again, it's the immediate reduction in taxes, generate positive cash flow, money that your clients can use, and ultimately, Carolyn, if you'll hit that next button there, the objective is just to put and facilitate cash to put it in your clients' pockets now. So what do we do? What are the elements that we study? As I said, we take a look at both the interior and the exterior of the building. And these are going to pop up here of the things that we're taking a look at. This first section here, these are elements that are deemed to be 5-year property. For those of you, I just have to, does everybody see the screen, even if we don't see them?
Yes. I think
Yes.
Yeah.
Okay.
Yeah.
Okay, great.
Oh,
So
look, solar. I just want to mention, I'm going to.
solar alert, solar alert,
Solar is on there.
solar alert. Solar is on there. Indeed it is. We will come back to solar. It is our extra special guest. So these here that you see are the interior elements. And then we've got the land improvements, which are your exterior elements. And those include things like landscaping, irrigation, curbing, fencing, etc. So again, we've got interior, we've got exterior. Okay, Carolyn. So what properties are best for cost segregation? Typically, we need to see about $1 million in building basis for this to pencil for folks. If people have existing buildings that they have improved, it's also very beneficial there. We need people to that are making money and paying tax, because if we're offsetting income. Key thing is that it's applicable to both new buildings as well as older purchases, and we're going to talk about that a little further. Just a handful of examples: hotels, apartment buildings, medical, really any type of commercial or rental income property is worth taking a look at. And this first went into the tax code in 1986. And we won't get into the tax weeds. Nobody wants to do that, but that's when it really kind of hit the radar.
So, Joel, is it, you can go backwards as you're saying here. So it doesn't matter when, most recently when you purchased your building, you could still do it. If you did it 5 years or more, you have this opportunity, or if you buy a building right now, right? Either way.
It is a great question, Marika, and it's one of the things also that even people that are somewhat familiar with cost seg, a lot of people will just equate it to, they just think it's for new properties only, and that's not the case. What the rules allow us to do is what's called a look-back study. So say, and this could be very applicable for you folks, because you are looking at individuals and property owners. They already have their buildings, many of them. What you want to do is be able to come in and get them to go green. You want to bring them into the 2021. Is that the 20th century or the 21st century?
I don't know. That always confuses me.
In any event, that's what you want to do. You want to bring them to today. So
Yeah,
what do we do?
Definitely today. At least today.
At least today. So the rules, they allow us, as I said, to go back and we catch up all the depreciation for the previous years. All the benefits then are pulled forward. So Benny, I see you there. You bought a building in 2015. You were not aware of cost segregation. And you said, heck yeah, I want to save some money on my taxes. How am I going to do that? So what we're going to do.
I have a question. Does that mean you have to amend your tax return?
Great question.
I don't want to do that, Joel.
Why, Stephanie? What's on that return?
Oh, no reason.
Okay. It's one of the great misnomers about cost segregation. And it's also a great question. People they get wigged when they amend my return. I'm not doing that. And we always know who are the most aggressive people on their taxes if we hit this point and their reaction to that.
Sorry.
But the answer is no. No, you do not have to amend your return.
That's amazing, really. That's amazing.
That's really good news, Joel.
In fact, it's in the code. For those of you that want to go into the tax code, probably nobody here. I wouldn't blame you for not wanting to anyway. But it's called a Section 481 adjustment, and it automatically happens. And once we do our work, if you'll keep going, Carolyn, then we work in conjunction with the building owner's CPA, and they file what's called a Form 3115. It's a change in accounting. Uh-oh, we got to run away. Oh, are we back? There we go.
Yeah.
Okay. It's a change in accounting. It automatically happens. People ask, well, do I need to call the IRS? Who the heck wants to call the IRS? No.
Yeah, is there anything you have to do, Joel?
You don't have to do anything. It just automatically happens. And that's, again, per the code and per the rules. So great questions and a very important piece to the puzzle. The other thing, too, that's important, and for us, as you see there, the certification stamp at the bottom of this letter, I'm very fortunate that I've got two terrific partners, one who is a CPA, the other who is a construction expert. They are two of less than 45 individuals nationwide that have gone through all of the requirements that are needed to be to have achieved the designation as certified cost segregation professionals. It is the highest designation in our profession. I think people that focus on quality and standards, which I'm sure many of you do, you know how important that is. Those are the people that end up working with us, and it reminds me of a story, because much like I'm sure all of you, from time to time, people think, oh, it's too expensive. I don't want to spend the money. I can get it for less. And it reminds me, I can think back to, I believe it was our 10th anniversary. And I went to see Herman Adler down at the Jewelry Mart. And I'm looking to get my wife a nice gift for her 10th anniversary. And Herman showed me, and I nearly fainted when I saw the price. And he said to me, and it stuck with me, he said, Joel, remember, the bitterness of poor quality lingers far longer than the sweetness of a low price. And you know what? He was right, because here we're married 30 years and she still has that. So quality, standards, we just feel that that's really important. It's important for us. We would think that it's important for the folks we work with and their clients. So,
well, especially if you get audited, you want to have that backup. You want that expertise, right? And that,
no question.
Hopefully you don't, but if you did, then you would feel comfortable that you wouldn't have problems.
And that really is a big part of it. And we're not concerned in the event that there ever are audits. It's not something that we are concerned about, again, because of the quality that goes into the work that we do. And I think that the question really becomes is for people, they have to ask themselves the question that if they were to pursue this, if they were audited, then do you really want to wonder about what's in your report and who actually did the work? And that's one of the things that we feel is real important. So with that, cost segregation and the impact here of COVID and the tax reform fallout and all that went along with that. So here's what happened. Bad news. Bad news. When all this hit, even before COVID, which was really bad news. But with tax reform, it was confusing, it was complicated, it was contradictory. We didn't really know what was going on. But then, as we sorted through it, there was some good news. Because cost segregation, not only was it left in place, but it really was enhanced. And it created even more benefit for property owners And again, the whole goal here is for you folks to think about your services of going green, and think about when people are looking at this, what's in the back of their mind? How am I going to pay for this? And we truly see the benefits that cost seg can bring in creating this cash flow. So we'll speak to, or we'll take a look a little further at how that works. So, tax reform 2017, prior to that, or excuse me, I should say after 2017, September of 2017, once we go in and we do our work and we segregate elements that are the 5 and 15-year components of a building, prior to tax reform, the owner would get the benefit of the 5-year property over the first 5. They would get the benefit of the 15-year property over the first 15. What happened with tax reform is we take all of that, every bit of it, and we roll it together. And all of these elements now are written off 100% in the first year. It's a huge, huge change.
That's crazy. That's crazy.
It's big numbers. It's big, big numbers. So to give you an example of what this means in kind of civilian speak, so to speak, if we assume that there's a building that has a basis of $5 million, generally speaking, we're going to find about 20% of that building on the lower end that will qualify for accelerated depreciation. And once again, this is on a brand new building or it's on an older building. And so if we accelerate 20% of that building, that creates an immediate tax deduction, a write-off of $1 million. And if we assume that many of your clients are in a 50% tax bracket, that puts $500,000 of cash flow into their pockets versus having to pay Uncle Sam. And this is, I think, it's an opportunity that when you're speaking with clients that are looking and considering the idea of going green, again, how am I going to pay for it? Well, if they own their building, the cash might be sitting right underneath the chair that they are sitting in, or maybe that they're zooming in, I guess, still for a bit. So
okay, can I put this in layman's terms?
Please.
So, can I interrupt you? Okay, so I buy a building, $5 million. About 20% or so can be, which is about $1 million, is a tax deduction, and basically saving me 50% of that based on whatever my tax bracket is, $500,000 reduction in my tax liability, right? So I'm going to have, if I owed $800,000 in taxes, I'm only going to owe $300,000. So I've made basically $500,000 on my purchase of $1 million right off the first year. I can write it off. Then that $500,000, where this is where CREGG comes in, is we go in and we can spend that $500,000 for long-term operating cost savings, investing that money, not just taking it, but investing it back into the building. So in essence, all those retrofits are kind of free, right? They're coming off your taxes. And then now your property one is valued higher because your net operating income is higher, and you've now made the operation much more efficient and you've brought it into 2021. So it's like kind of a no-brainer, right?
Exactly right. And to take it a step further, you've saved that $500,000, again, assuming 50% tax bracket. You've now spent the money to create, or you're going to spend the money in again, re-improving the property by going green. Well, guess what happens then? Then we can come back in. We can do a supplemental schedule on those improvements. those newly purchased improvements. And then there's an opportunity for the client to get an additional tax savings benefit via the money that they've spent on these improvements.
It's almost like a little bit like double dipping, but it's legal.
It's legit.
It's amazing.
It's
I need to buy a building.
Yes, it's legit. Frankly, you know, oftentimes the one of the biggest things that when people are not totally aware of this, they say to us, well, wait a minute, this is, how can this be? This is too, where's the catch? It's too good to be true. This, we can't. No, you can. You absolutely can. And I say to people, if you don't think so, if you got insomnia, go to irs.gov, type in cost segregation, read to your heart's content. It is all there in the code. It's really much like for you folks, for all of you. A big part of what you do, I'm going to assume, it's educating the public. It's bringing them into 2021 and all the things that are available to them. And this is, again, this is a way that can help bring them the cash they need to do so. So let's just take a look just at some examples of people that we've had the chance to work with, because a lot of times we'll talk about this and people say, oh, depreciation, this, that, it's all this tax stuff. Joel, what does it really mean? So what does it really mean?
Show me the money, Joel.
Show me the money.
Show me the money.
So these are actually some actual results and clients that we had the chance to work with. And as it turns out, not only did Marika and I go to UCSB, it also turns out that this particular hotel in North Hollywood, which Marika, I guess we can say it, right? We won't get,
Yeah.
We can say it. Okay. Marika said we could say it, we could say it. So it's the Garland Hotel that both Marika and I had the opportunity to work with. We did this project a few years back, and the net result was it created $500,000 in tax savings, and this was cash money that into their pocket. We recently completed as you see, a manufacturing facility in Corona. It's called Price Manufacturing. A great mixed-use apartment complex up in Santa Barbara. It's called Casa Anatega. If I was young and in Santa Barbara, and that'd be kind of a place I'd want to start out living if I could. Mixed use in Agora Hills. I think most people, if you've been up and down the 101, you've seen those signs for the Canyon Club. It's been there forever. It's within that shopping center along with the original Wood Ranch. So we worked with those folks, big savings there. And then most recently, a brand new retail strip center in the Chatsworth area where they saved over $700,000. So really, you know, I guess when we kind of tie it all together before we speak to any questions, cost segregation, it's found money.
Found money.
Yay.
That's really the way we look at it. So
you have money basically sitting in your building that you need to get out, and you can spend it on saving energy and reducing your operating costs and making your building more valuable, reducing your taxes.
yes,
All right.
100%.
Win-win.
Win-win.
100%.
Yeah, definitely.
Now, Marika, I know you wanted to go back to the solar question.
Yeah, let's start questions. And my first question would be, so you put on a solar on your building. How is that cost seg?
So solar panels, they are considered to be a 5-year asset as long as they are not the building's only source of electricity. And if they were purchased after tax reform went into effect, September 27th, 2017, then they qualify for 100% bonus depreciation. So if somebody spent $200,000, $300,000, $500,000 on solar, they are going to write all of that off immediately if they purchased it after September of 2017.
So if you did that right now, if you put on a solar system on your building or your hotel, you could write off the depreciation 100% the first year.
In the first
So that
year.
would help fund your basically fund it, help fund it.
Correct. Yes.
Plus you get but you also get the 26% federal tax credit because you bought it, right?
You could very well, that I would want to double check on.
Yeah, okay. That would be interesting how those two interrelate.
But you may, in fact, because you may get the tax credit, and I believe there is a chance that you could take advantage of both. But we can double check on that to be sure.
Yeah. Okay. And either way, it's found money.
No question about it.
Yeah.
And then Joel, I had a question. Can you just speak to an example as to how this has affected a hotel property or the hotel industry? Do you have any specifics?
Well, I think, as I said, the Garland was a great example, number one. But certainly number two, think about hotels now coming out of, as we enter into this next phase, aside from the cleaning and all that's going to go along with that, there's probably going to be hotels that recognize, hey, our properties are older and we need to bring them up to speed, and we have got to change out things like carpeting and lighting and the woodworking, and we've got to do things. We've got to bring things in that are going to assist with the air and with the electricity to make the entire property more efficient. So this is where, again, even if somebody has owned the building already, if they own a hotel and they're looking to spend, even if they were going to spend $300,000 on improvements, it would pencil to look at cost seg work to be able to take advantage of that, because the vast majority of that people would be able to write off.
Okay, fantastic. I saw Carolyn put in the chat for our audience to submit any questions you might have to Joel. So now's a good time to do that if anyone's curious about anything.
Yeah, any examples anyone would be interested in? So how long, one question I did have is how long is this does have a cutoff date with that new tax law, right? Is it only through a certain period of time at this point?
For right now, we are at least through 2023. Our understanding is that it will continue. I just see two questions that popped up here in the chat. What if you plan? And thanks for doing those questions. If any of you have ever had the chance to speak and you speak and then you're kind of hoping that there's questions, it's even worse when it's really live, but it's not so good in Zoom either. So thank you. We got two questions. I love it. Thank you.
Joel, Stephanie, Rika, I need to apologize. I was on mute and I'm trying to get in questions and I'm like, okay. Just being ignored. I was on mute.
That's all right, Benny. That's all right. You're getting a special award because you've joined the party live from the get-go. So you're in. So here, Benny, I'm going to address these two questions in the chat, and then I'll be happy to answer whatever questions. If you plan to own the property for a long time, how does this help? And think of it this way. There is a finite amount of depreciation that exists in every building, again, spread over 39 years. So the question becomes, do you want to get little teeny bites spread over 39 years? Or do you want to get a big chunk of that right away? In other words, maybe as much as between 15, when I think of some of the more certain properties that have more infrastructure, sometimes we get as much as 35% that we're able to accelerate. So it just all comes down to, we find that savvy business owners savvy CPAs and entrepreneurs, if they know that they can get their hands on this money now and not wait 40 years, they would like to have it now, because heck, we don't even know where we're going to be in 40 days, let alone 40 years. So give us the
So,
money.
Joel, so
Show me
Joel,
the money.
if someone's not like has kind of a bad year, they put in a lot of new stuff, and basically they don't need to take advantage in certain years. It's their choice. Is that still their choice to let it build up and use it when they need it, when there's a big tax bill?
It's a great question. And I'm going to tie your question, Benny, to Gary's question about this. What we do is we study the building. We provide those results to the client and to their CPA. They then, the CPA can best determine, and oftentimes in a collaborative fashion with my partner Kurt, of okay, here's the totality of our income situation. Should we use this now? Or, as you said, we had a down year. We want to get this done. We'll use it in future years. That's the option that a client has, number one. What Gary asked, and Gary, it's a great, great question, and the question Gary asked was, can you carry forward the tax savings to future years and for other properties? And the answer is yes. And this, again, is another very powerful part of it. So we talk about we're able to create $500,000 in tax savings. But maybe this year, because everybody had a down year, or many people did, maybe you can only use 250,000 of it this year. So you wipe out your income, you wipe up your tax liability for this year of 250, and then hopefully everything's going to turn around. We sure are optimistic. If you watch, the quote unquote experts, they say 2021, here we come. We're going to finish the year gangbusters. Well, hopefully that's the case. So then, yes, you'll have that remaining 250 to use in 2021 or beyond. Benny, one other part of your question. Once you start to utilize cost seg, then you're in. Once you put your foot in the water, it's not just your toe and you're not taking it out, you're jumping in the water. You can't say, all right, I want to use some of it this year, and then, then following year wasn't so great. Maybe I don't want to use it. No, it's there. But again, if you utilize it, you'll take advantage, and whatever you don't use, it carries forward. So I hope that answers your question. If not,
thank you.
We'll keep working at it. Okay, can commercial tenants in city, county, or other public buildings qualify? Brian, thanks for your question. Well, yes, commercial tenants in the city. I'm assuming that you mean people that don't own their buildings, but have rented the space. Let me address that portion of it. The answer is yes. If somebody has gone into a property that they do not own, but if they have spent their own cash on those tenant improvements, then the answer is yes, they can take advantage of this. If it's just made part of and built into their rent, where they haven't really been out of pocket to pay all of you folks for your services, then that would not be. County or other public buildings, do they qualify? That is a great question, and it is not something that I have ever been asked. So I am going to make a note about that, and we will find out about the answer to that. Public buildings.
And maybe, Brian, if you can put your email in the chat, Joel will get back to you with that answer.
Yep, I absolutely will. Here is a great question. Oh, good. Yeah, Brian, let me give you a high five. There we go. Let's go. All right. So another great question. What if you inherited the property? And this is I'll try to be serious here for a second now. Super powerful. Think about this. think about families, maybe multi-generational families, and think about those lucky folks whose parents bought apartment buildings in the valley in the 70s.
Yeah. Mm.
Think about what they paid versus what those things are worth today. So we'll just say, hypothetically, somebody bought an apartment building back 20 or 30 years ago in the valley and they paid $200,000 for it. Marika, Stephanie, is that a fair number or is that even too low?
That's fair.
Okay. So, and then that $200,000 purchase, Stephanie, if we go to the big wheel, what's it worth today?
25 million.
Probably.
Oh,
I know someone who's selling one right now and they had multiple offers, cash.
Oh yeah.
$25 million.
Okay. So, I mean, that was even more than I was expected.
All day long.
But,
yeah.
Here is the powerful portion of this. So the original purchase of $200,000, then the parents in my talking example here, the parents pass away, or the husband passes away and he leaves it to his wife, or both the parents pass away and it gets passed along to their children. Imagine people have heard of what's referred to as a step up at the date of death. So there is a step up in basis. And what happens is that $200,000, which is now 10 or 20 or 25 million, that $25 million now, the depreciation on that starts all over again. Wow. You reshuffle the cards, you reshuffle the deck. And what we do is then we go in there and we cost segregate based on the current value. And as such, it just creates, again, such tax savings. And truth be told, you know, for people that inherit these properties many times, there's no mortgages. Right. There's nothing. Can you imagine this? If the biggest problem that you had was you had so much money coming into your mailbox every month, and all you had to do was have your coffee in the morning and go out there to get it. And the biggest problem was, how am I going to reduce my taxes? Boy, wouldn't that be a nice problem to have? But that's really what has happened with a lot of these people. Because there's no mortgage, they have certain expenses, but by and large, the income is so large that, again, on the stepped up basis portion of things, we've had a major impact in that area. All right, let's see. We've got some other questions here. If your property is on a long-term, such as fast food rest, can you use cost seg? The short answer is yes. We do cost segs. We've done many. We've done many a Wendy's. I still think the McDonald's fries, you know, they're still at the top. We've done a lot of Wendy's, and so the answer there is yes. Publicly owned buildings, if you don't pay taxes already, what is the value of tax savings? If you don't pay taxes, you don't need us. We're not going to help you.
There you go.
You need us, but you don't need you.
Right. So, oh, this is great. Thank you. Thank you for these questions.
These are great questions, everybody. These are really great.
Yeah. Love it.
And anybody else provided really good answers too.
Thank you.
Yeah.
Anyone else have any other questions they'd like to throw Joel's way?
If there's a question about which is the best college basketball team in Los Angeles, I think we all got that answer last night for those of you that are following the Final Four.
Wasn't that incredible? Nobody saw that coming.
That's for sure.
That's for sure.
Such passion with those players too, you know, working so hard.
That's exactly right. All the work that not a lot of people see. So no, that was great.
Yeah.
All right. Any other questions?
Yeah, if there aren't any, feel free to reach out to Joel. There's his email, his phone number. If you have anything at all, any questions on energy efficiency, feel free to reach out to me. On title insurance, feel free to reach out to Stephanie. And we look forward to seeing you next month.
Hold on, Marika. Hold on.
Oh, we have another question.
Am I going to now pull for UCLA? Absolutely, 100%. Yes, yes. I'm tired of seeing that guy Timmy from, Gonzaga, as a basketball player myself. They are one hell of a basketball team. But I'm tired of seeing this guy Timmy do this. Enough of that already. I'm tired of that. And those kids from UCLA, they played their behinds off. And also, one of the kids is from here in Camarillo. Not Johnny, but his running mate. And I should know his name because I've watched him enough, even though our daughter went to SC. So that's why I was sad for SC, because she also worked as Andy Edfield's administrative assistant when she was in school there. And Andy is the nicest guy, still to this day, stays in touch with Rachel and is interested in her. So quality people. There's quality people, which on that note, one of the things I wanted to say, two last quick things, is number one, anybody that has any questions about this, we are all about front-end due diligence. We only want to look to pursue projects that make sense. If it doesn't make sense, we are going to tell you. We are not, thankfully, we don't need to, we are not in just the business of trying to collect fees. We look at properties, we get some basic information, and then we're able to provide an illustration of what the savings might be. And in turn, then that's money that you can think about that could go into helping your clients go green. So I wanted to make that point. And finally, and most importantly, my kidding aside for at least 1 minute, my real sincere thanks and admiration to the three rock stars, in alphabetical order, Carolyn, Marika, Stephanie. It's not easy to do all this stuff, and it takes a lot of time and a lot of effort, and it just shows the innovative entrepreneurs that you have been and you continue to be. And I'm grateful and I commend you. So everybody out there, standing ovation.
Thanks, Joel.
Thanks, everybody.